someone could create a third layer of another SPV because they got access to that second layer SPV down to that first layer SPV. And this might sound like a joke, but it's not. Some of the folks in our networks talking about the absurdity of a 6-layer SPV, literally 6 SPVs going down.
Hi, this is Matt Pauker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to the Investment Office. Every week, we're going to be pulling back the curtain on how the world's most sophisticated institutional investors, like Ivy League endowments, invest. Today, we're going to be covering a really interesting dynamic. Is anyone ever going to go public ever again? I think we've seen over the last few weeks, probably maybe a half dozen companies, private companies, raising monster rounds over $100 billion. Which is a really new dynamic. I don't think we had seen that even 10 years ago.
I think that's right. It really speaks to how much the both capital availability has changed in private markets. And it speaks to two things, which is demand for the ability to invest in these private companies, and then the access to actually be able to invest in these private companies. So when you think about why does a company actually go public, it's all part of a process of tapping into capital markets to raise dollars. There's a continuum across capital markets from private capital to public capital. And when a company chooses to go public, it's because they recognize two things. Typically, one, they are looking to raise so much more capital than they can tap into on the private side of the market that they need to tap into public markets. Liquidity event to allow the private investors who were previously invested in the company to be able to monetize some of their earlier private investments. So what we're seeing is that first piece where companies need more capital. And so previously they might have gone to public markets. The fact that there is so much more capital available in private markets means that a company doesn't need to choose that path specifically to meet their funding needs. And so all of a sudden, that's one reason that companies previously might have gone public, where suddenly it's not a necessity. And so if you think about all of the extra regulatory filings, the quarterly earnings reports, the shareholders, and needing to address shareholders on a regular basis. If you think about all of the extra tasks that come with being a public company, you can understand why if a company doesn't have to go public, it might choose not to. And so there is this dynamic now where the companies, the fast-growing private companies that are really in high demand from an investor standpoint, they are able to raise really meaningful rounds of capital in the private markets in a way where even 10 years ago, they would have likely gone public. If you
look at companies of the past and you look at the kinds of valuations these companies were achieving when they went public, right? I mean, you look at, Facebook at $100 billion, which almost now, at what a SpaceX or a OpenAI is raising at seems almost quaint. And then you go even further back, right? You look at Microsoft, raised at, a market cap of less than $800 million. It's a tiny fraction, orders of magnitude smaller than what we're seeing today. I mean, I remember, when I built my first startup and we started that back in 2002, which was just at the tail end of the dot-com boom and bust. If you had, call it $100 million in revenue, you were a great candidate to go public. These now are companies with billions and billions of dollars of revenue that are choosing to not take that path.
And they're still choosing to stay private, right? These are enormous funding rounds that are coming and staying within the private markets, which means that if you think about the excess value creation that used to occur after a company went public, that value accretion, it went to all of the public market participants who were investors in those companies. And if you think of all of that value, right, that 800, it's wild to me to hear that, and I know this, but to say it out loud again, that when Microsoft went public, it had an approximately $800 million market cap. Like that's wild if you think about how much additional value has accrued to investors in the public markets post its IPO. And then if you think about companies in the private markets now where the values There are $100 billion values that are still private companies. And then if you think about when those companies do go public, at some point, presumably, I think there's at some point where they will need to provide liquidity to their early investors. And so all of a sudden they are going public perhaps for a different reason. They may continue to raise capital from public markets. I think it's possible that at some point they will have a need for capital that exceeds what's possible in the private markets, although I continue to be shocked at how much capital is available in the private markets. But there's still that second reason why companies go public, which is to provide liquidity for earlier investors. But it is interesting to see that private markets are developing secondary mechanisms where early private market investors, those earliest investors, they can find liquidity within private markets. So all of a sudden, it's even that second reason for going public is starting to somewhat be less urgent. But I think that second reason, finding liquidity for early investors, will continue to persist. All of which is to say, if you
although I was going to say that
what's
interesting. What's interesting though there is I think that there has been this big shift in that dynamic as well. As you look at again, like going back to, when I started my first company in 2002, like the expectation in general was that the only way that you were going to ever get liquidity as a founder, as an early investor, as an early employee was to wait for that IPO. And then, over the subsequent years, we saw it become more commonplace as companies did raise, additional capital, for some of those early employees, some of those founders to be able to take a little capital off the table, to be able to sell some of their shares as more capital was raised. But now, right, you see that, you look at SpaceX, for example, a big chunk of that capital, raised as they announce these new funding raises these are tender offers that they're allowing broadly their employees to sell their shares. And, investors seem comfortable, obviously, with acquiring those shares, even though those are typically common shares that don't have a lot of the preferences and rights that preferred shareholders typically do.
Yeah, absolutely. Again, which just goes back to, it speaks to, there's this demand versus access equation where the demand is so high for some of these companies. And I would argue we can differ in what we think the, terminal values of some of these companies will be, but it's really hard to argue that there's real revenue growth. It's really hard to argue that these are real businesses that are growing enormously and generating value for their existing owners. And so, yes, there's this dynamic now where there are secondary markets in the private markets that function pretty effectively to the point where it is, like I said, I don't think the need to go public to provide liquidity to investors will ever go away, but it provides a pretty good interim solution for folks where it doesn't serve as enough of a push to prompt these companies to go public before they want to, which that's the biggest question is now, when do they want to and why do they want to?
Yeah, it's almost, maybe they never do. And so that's an interesting dynamic. I think the other interesting dynamic we're seeing is structurally how these companies are creating access and raising capital from individual investors, and the rise of these SPVs, these special purpose vehicles, which have been around a long time. So, SPVs, I would say, probably became more and more popular in venture in the mid-teens, but we're now seeing this situation where you're seeing SPVs on top of SPVs and fees on top of fees, and I think that's a troubling dynamic. Maybe first we could talk about like what is an SPV and why does it exist?
So an SPV is a special purpose vehicle. It's a structure where the manager of that special purpose vehicle will take investors through the SPV. So it allows individual investors or a collection of investors to aggregate their capital together into this SPV. And then this SPV will be the single purchaser holder of shares of a company, a private company. So SpaceX is a good example. That is one where, as we mentioned, a lot of demand when it does announce that it's looking to either allow employees to tender their shares or looking to raise new capital. And what you'll see are that folks have been given the right to invest into the company. They may have been allotted a certain amount into whatever that funding round is. And then that whoever the manager is or the SPV manager is will say, I've got a $15 million allocation, a $50 million allocation. And so rather than putting in the dollars themselves, whether that manager is a fund or is an individual, they'll say, I'll create this SPV, I'll create effectively an access vehicle. And if you know me, then I'll let you be part of this SPV, providing you meet some investor qualifications, typically wealth qualifications. And then because I'm providing you access, it's literally just an access vehicle. Because I'm providing you access, I'm going to, within this SPV, charge you a management fee and typically 20% carry. And so that's somebody, that first layer SPV is not, again, like you mentioned, Matt, like it's not unusual at this point. They are a commonly used vehicle in private markets now, where it is giving a manager the opportunity to aggregate underlying capital. And so in the case of these highly sought after companies, what we're seeing, the troubling dynamic is you have folks who are creating an SPV because they have been allotted some portion of dollars that they can invest into the company. They then go to, other individual investors, and an investor they have gone to who says, oh, well, now I have access to SpaceX through this SPV, but I know I've got 100 other folks who would want access to SpaceX who aren't going to be able to invest directly. And so I'll create my own SPV. And now all of a sudden you've got someone else saying, well, I'm going to sell access through the access that I purchased. And so now you've got this basically Russian nesting doll of SPVs where you've got a second SPV funneling dollars into that first SPV. And then you can imagine how someone could create a third layer of another SPV because they got access to that second layer SPV down to that first layer SPV. And this might sound like a joke, but it's not. There's been recently, a reference to some of the folks in our networks talking about the absurdity of a 6-layer SPV, literally 6 SPVs going down. And then at some point you lose that chain of ownership, which I think is the scarier thing, not just it's offensive, it's insulting how many layers of fees are being collected along the way, because that's all these are. These are just access vehicles, right? And so the fees themselves are insulting enough. But then the real challenge becomes, how do you continue to maintain that validation of ownership, right? Because the entire reason that first SPV, that initial access vehicle, is valuable is because it actually owns the shares of whatever company it's investing into. That second SPV just owns shares of an SPV, and then the further removed you get, you own shares of an SPV. I mean, and then you have to trust that each manager under within that Russian nesting doll is not fraudulent. Again, there's just like so many things about this that it speaks to. I mean, we laugh about the absurdity of all this, but it speaks to this just massive disconnect, again, between demand and access, right? And so the demand is so high that people are willing to pay absurd amounts and take on really, from an institutional investor's perspective, are willing to take on just an unacceptable level of risk from both a governance standpoint and also from are we confident this investment exists? And once you go through all the different layers,
it's wild. And listen, full disclosure, I invested in a SpaceX SPV back in 2018. So it was a single layer SPV. There was I know the manager. It was all relatively transparent. But it's also crazy from the company standpoint, in the sense of, typically, historically, right, to your point, these SPVs were designed to allow a company to raise additional capital, and in some sense, often to reward an existing investor with some additional allocation beyond what they could take down out of their permanent capital. But there was some trust there, typically, that the SPV was being run and managed by somebody who knew the underlying capital that was being aggregated. And now it's like, okay, Anthropic, it's an SPV on top of an SPV. Anthropic has now at this point no idea who the underlying investors in their business fundamentally are.
Well, I would argue that at some point it becomes a question of whether the SPV it becomes a legal question from SPV to SPV, right? Like they know who their owners are. It's the investors to that initial SPV, right? Because later owners are just owners in SPV. At some point, I'm not sure the company would recognize the ownership as being ownership in the company. And so that's the other danger to being an investor in an SPV, it's 6 layers deep, is it's questionable whether the company recognizes that as ownership, right? You don't really have the same ownership rights. You're not the ones in that first, again, it goes back to what is the dynamic and legal agreement between the first SPV and the second SPV even. Does the second SPV then get to direct the first SPV in terms of how they vote their shares? Maybe, but probably not, right? And so at some point you start to just lose all the value of that ownership of those shares. So I don't know. I'm not sure at what point it just gets disconnected completely, but it's another.
Well, and that's a good segue actually to another topic very related, which is the tokenization of private shares. The Robinhood has been probably the most vocal and prominent here. Launching or announcing that they're going to launch a new blockchain-based effort to tokenize shares of private companies like OpenAI and make them available initially to investors outside the U.S., although I think their plans certainly are to bring that here to the U.S. as well. And I think a lot of the same questions there, if you buy a tokenized share of OpenAI on Robinhood, like what do you really own and what does that actually mean? And I mean, especially in the case of OpenAI here, where they're saying that they don't even really recognize this and they're not participating in it.
When OpenAI was like, no, thank you. we don't condone that, and we don't want any part of this. That was, best case scenario in this tokenization effort. The best case scenario is that the private company itself is willing to recognize that ownership, right? And OpenAI sort of just flat out has already, dispelled us of that potential. And so it really is, it becomes so much more of a question of what does that actually mean? What do you actually own, right? Although I'll defer to you on the dynamics of tokenizing shares, given your particular area of expertise on that one.
Yeah, I spent perhaps too long in crypto world, but in the early days. But I understand why they're doing it, which is there is an immense amount of liquidity in crypto world, particularly liquidity outside the U.S. Right? There's just been an incredible amount of wealth created over the last decade. Whether it's in Bitcoin or at ETH or some of the newer tokens, this is liquidity that is looking often for new ways to deploy capital, and if Robinhood can tap into that liquidity, I think it's compelling, and I can imagine they'll have a lot of takers for it. But what it really kind of illustrates is a broader question around crypto and tokenization, which is, how does it interact with the real world? Because at the end of the day, you can build a token that represents anything, right? You could build a token that, represents a Pokemon card, or you could build a token that represents a piece of gold, or you could build a token that, represents a share in OpenAI. But at the end of the day, if the thing that the token is representing is a what's called a real world asset, you hear about these RWAs, these real world assets. That real world asset sits somewhere, right? Like that Pokemon card sits in my son's binder, or the gold sits in a vault somewhere. And if I come and present that token to you for the bar of gold, it only does me good if someone is actually going to agree that, if I want to move that bar of gold from vault A to vault B, somebody's got to be willing to do that when I present that. And so if, someone presents their tokenized share of OpenAI and says, oh, I want to vote this, and OpenAI says, well, we don't recognize that, then okay, what do you really own?
Exactly. And I suspect that there's another aspect to this, which is presumably, going back to our earlier topic on SPVs, presumably I would think that Robinhood owns shares of the companies that is proposing to tokenize, that Robinhood likely owns them directly, and I could see them putting them into an SPV, and as opposed to taking in investors into the SPV, they tokenize the SPV. So then they would at least, again, this is all hypothetical. I have no idea. We're making a lot of assumptions here. And then assuming that is how this works, that it's being put into an SPV and the SPV is being tokenized, and those token holders then own the tokens and have ownership of the SPV, presumably then at least Robinhood would acknowledge that that's what the ownership corresponds to, and that's what the collateral there is. But how that all works and the pricing and all of that, I think, is still a little bit up in the air because, again, Robinhood would have a lot of say over how all of those mechanisms work.
It's certainly not very decentralized or trustless, which obviously is kind of those are presumably two of the points of this all.
To be fair, we're guessing at it here.
Just speculating. We're guessing because this is all at this point all marketing. Putting your institutional investor hat on, how does an institutional investor think about all this, right? Would an institutional investor ever go into an SPV? Would they ever buy a tokenized share of anything?
So I think the big distinction is going back to that demand versus access piece. Institutional investors don't have as much trouble where it comes to the access side. And so where institutional investors are typically finding paths to be investors in companies, they're investing in the venture capital firms that are going to be the big backers of these companies early on. And so institutional investors will oftentimes have exposure through the funds in which they're investing, or if they are being offered an SPV because perhaps the fund in which they're invested is being offered a sizable allocation to a really exciting private company that's raising capital. And so that venture firm has been granted allocation above what makes sense to go in the fund, so they might create an SPV and bring in their LPs, the institutional investors, into that. Those type of SPVs are often offered to LPs at no fee and discounted carry, right? So it is like a polar opposite scenario versus what you're seeing in the SPV dynamics being offered to individual investors. Those SPVs are being offered to their investors. Venture fund SPVs are being offered to their LPs to encourage investment into the fund, to sort of build that partnership between the two. And so it's meant as a mutually beneficial offer. And so it's not going to serve as a price gouging exercise, for lack of a better term. And then in other scenarios where an institutional LP might look to access a company that it doesn't have exposure to in its underlying portfolio, again, it would typically be in conversations with managers that they might know well. And so they would know the sponsors of the SPVs if they were to consider an SPV, which would be, for a variety of reasons, typically an unusual thing to do. But I won't go too much into why institutional investors typically wouldn't step outside of where their existing investors are investing. It happens from time to time. Certain institutional LPs and investors have a longer history of doing that, whereas I think the majority, if I were to speak sort of like what's more common, it's majority of institutional LPs are typically not doing those one-off investments in SPVs. And then in terms of tokenization, I think that is something that's just sort of still so new. I have not heard of any institutional LPs necessarily going down that path. Again, this goes back to that demand versus access piece of it, where these become solutions for access that institutions don't need those solutions because they already have access and solutions elsewhere. And so it really gives me cause for pause when I think about, well, these solutions are, I think solutions are useful and necessary. And because there is more demand than there is access, they are really, clearly meeting a need. It's just then a question of what are the trade-offs in order to meet that access.
Fascinating. Well, I think it'll be, if nothing else, interesting to see how this develops over the next few years.
Oh, definitely. Capital markets are definitely changing and evolving in some pretty surprising and quick ways.
A good topic for a future session. Awesome. Well, thanks everybody for joining us. We'll see you next week on the Investment Office.